You're listening to the REITE Club podcast, where the focus is all about helping you grow your real estate investment portfolio and live the life you want to live. Come grow with us and join our community at thereiteclub.com. And now your hosts, Sarah Larby and Alfonso Salemi.
But at the end of the day, it tends to be insurance that is the winner in terms of the strategies when you look at the pros and cons of various ways of dicing it up. And there are strategies where you can get into insurance and have it as an asset class. It's just not an outflow that people traditionally view it as, where it's just money out the door, that they're sort of renting money. You can have permanent coverage, and permanent coverage is an asset. It is on your balance sheet. You know, you have ABC Holdco that has real estate holdings, investments, whatever it is, cash. You hold cash value in an insurance policy that is growing tax-free. And it's also paid out upon death tax-free. And you can also borrow against it at 100%. So there's just all these mechanisms that the high net worth and the ultra high net worth with good advisory teams have in fact put in place several times in the country. It's what I got exposed to previously. It's the message that I help spread. It can get quite interesting in terms of some of the custom solutions.
Yeah, and I want to unpack that a little bit that you went through. There's a lot of things that I was trying to keep notes and keep tabs here. So basically, if we're starting with, you said approximately a 15 million value of a portfolio. That's through all different types of strategies in real estate, and it costs us basically 5 million. There's an exposure, or there's a 10 million in capital gains that essentially are being paid at some point, right? And that's at a point of a death. So the first question I had that I wrote down here,
if it passes on, like anytime you transfer, right?
So the owner. Okay. So are there any other examples besides like a death that, you know, like if it is selling of a property, or if it is liquidating, say, to cash in, maybe you're moving that portfolio around so that your cost base maybe goes up to 6 or 7 million, but then your assets go up to 20, like that enacts that capital gains, or that you could be protected in that case?
Yeah, so that example that I gave, it's something where you could look at it and say, this is what the holdings, we can talk about today, right? We can also talk about the trajectory for decades and decades and decades. So you're going to have a different situation if you're an investor who is turning properties over every 5 years, and there's, let's say, a turnover in your portfolio, versus an investor who says, you know what, I've amassed these properties, and, you know, property A, B, C, D, I can't see getting rid of these. They're just producing great cash flow, and they're wonderful properties. But maybe D, E, F, G is more of a short-term play. There's some value creation, etc. I want to reap the benefits. I want to capitalize on that and move on and create money and use that money. The stuff that's turning over regularly, you are going to have some exposure to that upside because you've created value. A great example is the developer. So I've worked with several developers. They're very interesting in terms of their models. So you will have gains where it's in the tens of millions, but it's not necessarily long-term in nature. It will turn over, right? You've got this land acquired. You've got a change of the zoning. You've got approvals for whatever you're going to do on it. You've created all this value right there. You've created a ton of value. In those cases, we're talking about tens of millions, very large numbers. So there's exposure for that time being. And you don't necessarily forecast out and say, okay, today we've created $30 million of value, current market values versus cost base.
Yeah, over the next 30 years or 10 years or 15 years, right? Over that span.
So that example there, you may say, well, this is sort of a 5-year cycle, 10-year cycle, 3-year cycle, whatever cycle it is. But you're going to pay the taxes from all the gains during that cycle. And then you're going to have a bit of a reset button again, if that makes sense. So it's different than, you know, I am holding on to, I've got my 15 million value today and my cost base of 5 million. At a 5% growth rate, let's say it doubles every 15 years. So that 15 million in value turns into 30 million in 15 years. That 30 turns into 60 in 30 years, right? So if you're saying, okay, my life expectancy is about 30 years from now, and maybe it's me and my spouse, our expectancy is 30 years from now, you say, okay, what's 60 million? And I plan on holding on to all this stuff, right? I just don't, you never know what will happen, but I want to plan for those contingencies, right? I don't want my next generation to inherit some huge tax bill upon transfer. So those are the different permutations, if you will. All of this is mapped out in a ton of detail in terms of the analysis and spreadsheets and customized discussion for the client. Does that help?
Yeah, I mean, I can definitely see how it can get complicated, but here's my question. So, what if I want to avoid capital gains sooner while I'm still alive? And, by all means, if I can avoid it upon death, sure. But talk to me about when you said developments, that's like essentially my next big thing that I'm working on. So let's just say I want to look at that and might be a little bit shorter term. How do I avoid paying the capital gains using maybe, like you mentioned, insurance or different options? Like, what does that even look like, or is that even possible?
Yeah, so, I mean, look, this podcast would be worth about, I don't know how many $1 trillion if we can figure out all the tools to sort of not pay taxes in this country. But all kidding aside, I think the reality is that I'm sorry, I'm going to say it, it's so cliche. There are two certainties in life,
death and taxes, right?
So in terms of avoiding paying capital gains, I mean, if there are legitimate gains and a ton of value created, our taxation environment gets their hands on it. I will again throw the disclaimer out there just to cover my bases that I'm not a CPA. In terms of all the strategies that we can avail of, I can't speak to the whole plethora of it. And even if I could, I would sway away from that in terms of providing tax advice. I think that if you do look at the math and you say there are gains here, there's value created, the second part around doing the second part two of the math is what is the best way of solving for it. That we can definitely talk about, right? Because you park cash. If you transfer that cash to the next generation, half of that gets taxed. It just goes away. So there's just a ton of erosion of value there. You use life insurance, that's something that is incredibly tax efficient. It is, it grows tax-free and it's paid out tax-free. So then you start sort of comparing the various options. And then if you are having to pay taxes, any event that's triggered by death, at least, typically it's insurance that's a great way of dealing with it. Sometimes you get involved in situations where you say, okay, there's a lot of value here. I'm going to pass on this value to the next generation. So you can take it off your hands and give it to the next generation at a certain value today and say, well, it is 15 million versus 5 million cost base. There's 2.7 that does get paid today, but we've sort of, as of today's value, you sort of lock it in, it's 2.7 million. And then you're not exposed to that further upside. This is an estate freeze strategy where you say, okay, now I'm going to get coverage of 2.7 million upon my death down the road to settle that, right? And then you sort of lock it in and you mitigate it that way. But then the next generation is responsible for all that future growth. You've just kind of deferred it. I'm sorry, it's, if we get into tax,
it's always coming. It's always going to come, and it always will. But let's kind of shift gears a little bit. And Ara, I know we've had a bunch of good conversations and talked about different strategies, right? Between what the general masses are doing, and high net worth and ultra high net worth type of people, right? And how they leverage credit and they use credit. And at the time that we're talking about this, and I don't want to get into it too much, right? There's a lot of shift going on in markets in different areas of the world and things that are going on. But let's just kind of from a higher level talk about the difference between, and maybe explain the difference between the general masses and net worth and high net worth people, how they use credit.
Yeah, so I can speak to the credit piece, but I think there are some interesting observations around some tools used by the ultra high net worth and the high net worth and overall strategies. When it does come to credit, I would say that credit is absolutely viewed as, when I started in private banking, we would say, people think that the wealthy don't borrow for some reason, right? And it's completely the opposite.
Thanks for listening to the REITE Club podcast and joining our community of real estate investors online at thereiteclub.com, where the focus is about helping you grow. We look forward to seeing you again next week. Thanks from your hosts, Sarah Larby and Alfonso Salemi.